Hello and welcome back to Money Mastermind. Today we are exploring how to choose the best assets for your portfolio. Now let's get started. But first, if you enjoy this content or anything related to investing, be sure to like and subscribe for more videos like this. Now let's get straight into it. Portfolio management plays an important role in the world of finance. At its core, portfolio management involves the thorough selection and allocation of assets to optimize returns while managing risk. Within this framework, the process of asset selection emerges as a critical component, shaping the trajectory of investment outcomes. Choosing the right assets for your portfolio is like selecting the finest ingredients for a recipe. It requires foresight, analysis, and a deep understanding of your financial goals. The assets chosen will ultimately determine the performance and stability of your portfolio over time, whether the objective is wealth accumulation, retirement planning, or capital preservation. The careful selection of assets is key. Each asset class possesses unique characteristics, risk profiles, and growth potentials, making the process of selection diverse and complex. Also, the art of asset selection extends beyond simply picking individual securities. It encompasses broader considerations such as asset allocation, diversification, and risk management. By selecting assets strategically, you can construct your portfolios that not only withstand market changes but also thrive in diverse economic environments. The journey toward achieving financial goals begins with the thorough selection of assets. In the later sections, we will dive deeper into portfolio management, exploring various asset classes, factors to consider when choosing assets, and strategies for aligning portfolios with specific financial objectives. Through this exploration, you will gain valuable insights into the art and science of building a strong investment portfolio. Portfolio management serves as the process of overseeing an individual's or institution's investment portfolio with the primary goal of maximizing returns while mitigating risk. Portfolio management consists of strategic allocation of assets to achieve specific financial objectives within a defined time frame. One of the central objectives of portfolio management is to optimize the risk-return trade-off. This involves balancing the desire for higher returns with the need to protect capital from potential losses. By diversifying across different asset classes, industries, and geographic regions, we aim to minimize the impact of adverse events on overall portfolio performance while still capturing opportunities for growth. Asset allocation is a key component of portfolio management, representing the distribution of investments across various asset classes such as stocks, bonds, real estate, and cash equivalents. This strategic decision significantly influences portfolio performance and volatility. Studies have shown that asset allocation accounts for the majority of a portfolio's returns over the long term, highlighting its importance in achieving investment objectives. Also, asset allocation is tailored to individual risk tolerance and investment horizon. Risk tolerance refers to your willingness and ability to withstand changes in the value of your investments. Investors with a higher risk tolerance may allocate a greater proportion of their portfolio to equities, which historically offer higher returns, but also come with increased volatility. Conversely, investors with a lower risk tolerance may prefer a more conservative allocation, with a higher emphasis on fixed income securities. Investment horizon, on the other hand, refers to the time frame over which you expect to achieve your financial goals. A longer investment horizon typically allows for a more aggressive asset allocation, as there is more time to recover from short-term market changes. Conversely, investors with shorter time horizons may opt for a more conservative approach to protect capital and ensure liquidity when needed. In summary, understanding portfolio management involves grasping the objectives of maximizing returns while managing risk, implementing strategic asset allocation to optimize performance, and aligning investment decisions with individual risk tolerance and investment horizon. By mastering these concepts, you can construct portfolios that are well positioned to meet your financial goals over time. In the world of investment, a diverse selection of asset classes offers opportunities for growth, income, and wealth preservation. Understanding the characteristics, risks, and potential returns associated with each asset class is essential for building a well-balanced and resilient investment portfolio. In this section, we will examine the types of assets. 1. Stocks, Stocks represent ownership shares in publicly traded companies, offering potential for capital appreciation and dividend income. However, they also carry higher volatility and market risk compared to other asset classes. Historically, stocks have delivered higher long-term returns, but their performance can be influenced by factors such as economic conditions, corporate earnings, and market sentiment. 2. Bonds. Bonds are debt securities issued by governments, municipalities, or corporations, providing you with fixed interest payments and return of principal at maturity. Bonds are generally considered less risky than stocks, but may still be subject to credit risk, interest rate risk, and inflation risk. They offer lower potential returns compared to stocks, but can serve as a stabilizing force in a diversified portfolio, especially during periods of market volatility. 3. Real estate. Real estate investments involve purchasing properties or investing in real estate investment trusts, which own and manage income-generating properties. Real estate offers potential for rental income, capital appreciation, and portfolio diversification. However, it also carries risks such as vacancy rates, property maintenance costs, and market changes. Real estate can provide inflation protection and act as a hedge against stock market volatility. 4. Commodities. Commodities include physical assets such as gold, silver, oil, and agricultural products, as well as financial instruments such as futures contracts. Commodities offer diversification benefits and can serve as a barrier against inflation and currency depreciation. However, they are subject to price volatility, supply and demand dynamics, and geopolitical factors. Investing in commodities requires careful consideration of market conditions and risk management strategies. 5. Alternative investments. Alternative investments cover a wide range of assets beyond traditional stocks and bonds, including hedge funds, private equity, venture capital, and cryptocurrencies. These investments often exhibit low correlation with traditional asset classes and can improve portfolio diversification. However, they may also involve higher fees, illiquidity, and regulatory risks. Due diligence is crucial when considering alternative investments, as their performance can vary widely. Diversification across asset classes is fundamental for reducing portfolio risk and enhancing long-term returns. By spreading investments across different types of assets with varying risk-return profiles, you can mitigate the impact of adverse events on your portfolios and capture opportunities for growth across various market environments. When selecting assets for an investment portfolio, you must employ a blend of analytical tools and considerations to make informed decisions. Fundamental and technical analyses serve as essential frameworks for evaluating assets, while various factors such as historical performance, volatility, correlation, and economic indicators offer valuable insights into their potential risks and returns. Factors to consider. 1. Fundamental analysis. Fundamental analysis involves assessing the intrinsic value of an asset by examining factors such as financial statements, earnings growth, competitive positioning, and industry trends. This approach focuses on understanding the underlying fundamentals of an asset to determine its investment potential over the long term. Fundamental analysis is particularly useful for evaluating stocks and bonds, helping you identify undervalued or overvalued opportunities based on their fundamental characteristics. 2. Technical analysis. Technical analysis, on the other hand, relies on price and volume data to analyze market trends and predict future price movements. Techniques such as chart patterns, trend lines, and technical indicators are used to identify patterns and signals that may indicate buying or selling opportunities. While technical analysis is primarily applied to short-term trading, it can also provide valuable insights for timing or entry and exit points in longer-term investment strategies. 3. Thorough research and due diligence. Before making investment decisions, thorough research and due diligence are essential. This includes analyzing financial statements, conducting industry research, evaluating management teams, and assessing large-scale trends. By conducting comprehensive research, you can make well-informed decisions that align with your investment objectives and risk tolerance. In addition to fundamental and technical analyses, you should also consider these key factors when choosing assets. Historical performance. Assessing past performance provides insights into an asset's volatility, returns, and risk-adjusted performance. Volatility, Measure of an asset's price changes over time, indicating its level of risk. Correlation with other assets. Understanding how an asset behaves relative to others in a portfolio helps diversify risk and optimize asset allocation. Economic indicators. Consideration of factors such as interest rates, inflation, GDP growth, and geopolitical events can influence asset prices and market trends. In conclusion, choosing the right assets for your portfolio requires an approach that incorporates fundamental and technical analyses, consideration of key factors, and diligent research. By leveraging these tools and practices, you can construct portfolios that are well positioned to achieve your financial goals over the long term. A crucial aspect of successful portfolio management is aligning asset selection with specific financial goals and risk preferences. Tailoring a portfolio to your objectives ensures that investments are optimized to achieve desired outcomes while managing risk effectively. Here are a few tips to tailor your portfolio to your goals. Aligning asset selection with goals and risk preferences. You must first identify your financial goals, whether it's retirement planning, wealth preservation, capital growth, or a combination thereof. Understanding your risk tolerance is equally important, as it determines the level of volatility and potential losses you are willing to endure. By aligning asset selection with these goals and risk preferences, you can construct portfolios that are well suited to your unique circumstances and objectives. Strategic asset allocation. Strategic asset allocation involves setting target allocations to different asset classes based on long-term investment objectives and risk tolerance. This approach recognizes that asset allocation is the primary driver of portfolio returns and emphasizes diversification across asset classes to minimize risk. For example, a strategic asset allocation for a retirement portfolio may include a mix of stocks, bonds, and real estate investment trusts tailored to your time horizon and risk tolerance. Tactical asset allocation. Tactical asset allocation involves making short-term adjustments to the portfolio based on changing market conditions and investment opportunities. Unlike strategic asset allocation, which is more static, tactical asset allocation allows for flexibility in response to market dynamics. For instance, during periods of market volatility or economic uncertainty, you may increase allocations to defensive assets such as bonds or cash to reduce downside risk. You should also consider these portfolio strategies for different objectives. Retirement planning. For long-term retirement goals, you may adopt a strategic asset allocation that prioritizes growth-oriented assets such as stocks and real estate to maximize returns over time. Wealth preservation. Those seeking to preserve capital may opt for a more conservative allocation with a higher emphasis on fixed income securities such as bonds and cash equivalents. Capital growth. For those focused on capital growth, a balanced approach with a mix of growth stocks, dividend-paying equities, and alternative investments may be suitable to generate higher returns while managing risk. In summary, tailoring a portfolio to your specific financial goals and risk preferences involves strategic asset allocation, tactical adjustments, and consideration of various portfolio strategies. By aligning asset selection with your objectives, you can build portfolios that are well positioned to achieve long-term success. Implementing a chosen portfolio strategy involves a series of steps aimed at translating investment objectives into a well-structured and disciplined approach. From initial asset allocation to ongoing monitoring and adjustment, a systematic approach is key to achieving long-term success. Here is how to implement your portfolio strategy. Asset allocation. The first step in implementing a portfolio strategy is determining the appropriate asset allocation based on your investment goals and risk tolerance. This involves allocating percentages of the portfolio to different asset classes such as stocks, bonds, real estate, and alternative investments. Asset allocation decisions should reflect your time horizon, financial objectives, and risk preferences. Selecting individual assets. Once the asset allocation has been determined, the next step is selecting individual assets within each asset class. This involves researching and analyzing specific investment opportunities, considering factors such as historical performance, risk-return profile, and correlation with other portfolio holdings. Diversification within asset classes is important to spread risk and enhance overall portfolio resilience. Monitoring performance. After implementing the portfolio strategy, it's essential to monitor the performance of individual assets and the portfolio as a whole regularly. This involves tracking investment returns, assessing portfolio volatility, and evaluating whether the portfolio is on track to meet its objectives. Monitoring performance allows you to identify any deviations from the desired asset allocation and take appropriate corrective actions. Portfolio rebalancing. Occasional portfolio rebalancing is necessary to maintain the desired asset allocation ratios and ensure alignment with investment goals. Rebalancing involves selling assets that have appreciated in value and reallocating the proceeds to underperforming assets or those that are underweighted relative to the target allocation. By rebalancing the portfolio, you can control risk exposure and prevent drift away from the intended investment strategy. Staying disciplined. Finally, staying disciplined and avoiding emotional decision-making is essential for long-term investment success. Market changes and economic uncertainties may tempt you to deviate from your investment strategy out of fear or greed. However, it's important to commit to the predetermined asset allocation and investment plan, focusing on the underlying fundamentals of the portfolio rather than short-term market movements. Now, to summarize, implementing a portfolio strategy involves careful consideration of asset allocation, selection of individual assets, monitoring performance, and periodic rebalancing. By following a systematic approach and staying disciplined, you can navigate market volatility and pursue your financial goals with confidence. In this video, we've explored the fundamentals of portfolio management, emphasizing the importance of asset selection, strategic allocation, and disciplined implementation. Let's recap the key points covered. Portfolio management involves selecting and allocating assets to achieve specific financial goals while managing risk. Understanding asset classes such as stocks, bonds, real estate, commodities, and alternative investments is essential for building a diversified portfolio. Factors like historical performance, volatility, correlation, and economic indicators guide asset selection and allocation decisions. Tailoring portfolios to your goals and risk preferences through strategic and tactical asset allocation strategies is essential. Implementing a chosen portfolio strategy involves selecting assets, monitoring performance, and occasional rebalancing to maintain desired asset allocation ratios. We encourage you to apply the principles of portfolio management discussed in this video to build a diversified and strong investment portfolio tailored to your financial objectives. Remember to conduct thorough research, stay disciplined, and regularly review your portfolio's performance to ensure it remains aligned with your goals. We value your feedback and questions. Feel free to share your thoughts, experiences, and inquiries in the comments section below. Your engagement encourages a collaborative learning environment and enables us to provide more valuable content. Thanks for watching Money Mastermind. If you enjoyed this video, be sure to check out our other videos for more investing tips. Don't forget to like and subscribe to stay updated on all our latest videos, and we'll see you in the next one.